Hey everyone, this is Sean Leland with Next Mortgage, and I've done a couple different videos on DSCR loans, but I wanted to go a little bit more in depth on the approval process. But first off, let's take a peek at what a DSCR loan actually is and some of the benefits. So DSCR stands for Debt Service Coverage Ratio. So when looking at the eligibility of a borrower, we just look at whether or not that debt is getting serviced. Everything should be serviced, right? Anyways, as we look at the ratio, the R in the debt service coverage ratio, that ratio is going to be anywhere between like 0.75 and sometimes 1.25. It could be even higher, 1.4 or whatever. The higher the ratio, the better the terms for the loan, and usually the cheaper the closing costs are going to be, the lower closing costs are going to be. If you're looking at 0.75 or something like that, you're pretty much screwed when it comes to closing costs and interest rate. But sometimes, in a pinch, I've got lenders that will go as low as 0.75 for you people out there. And if you're sitting, with a hard money loan and you're paying interest only, yeah, the 0.75 starts looking a little bit more advantageous when you start thinking about actually paying principal as well as tax and insurance in that payment, kind of like a normal loan, right? So other benefits include the personal income tax verification. So we aren't dragging you to the proctologist's office and whipping out your personal income taxes or your business income taxes and having some underwriter strap on the rubber glove for you. We're only looking at the eligibility of that individual property, right? So that's what makes it beautiful, because most investors out there haven't paid income taxes in years, according to the federal government. And so it's kind of hard to qualify for loans. That's why everybody goes to hard money loans, which I have hard money loans for those of you interested. Anyways, there is a faster approval process. Of course there's a faster approval process because we're not going through conventional guidelines. And when I flip over to the spreadsheet, you'll see kind of how the approval process can be quicker. Many more investment opportunities. So let me describe a scenario for you. For example, let's say you've got two different fourplexes, and both are cash flowing like an open spigot, like broken pipes in the winter. They are just cash flowing, and you've got decent equity. So let's take equity out of two of those. Let's do a cash out refi out of two of those, and then let's use that equity and roll that into the purchase of another. So rather than go into hard money for the purchase of another, let's just get our 20%. So we've got our minimum 80% LTV, and cash out refi in those two, roll into the purchase of another. And now all of a sudden you've got three fourplexes or whatever you're purchasing that are cash flowing for you. Just love the product, quite honestly. So that really kind of describes the opportunity as well as the flexibility to some extent, in that with the flexibility you can close in an LLC, you can close more than one at one time, like I just described with doing a cash out and a purchase at the same time. You can do a portfolio loan. Working for Nexa, I've got like 80 billion different lenders that I work with, and they're all competing basically by offering pretty awesome programs for every unique situation. So there's a lot of flexibility when it comes to non-QM DSCR loans. And then the scalability, like I described before, it's easy to kind of parlay one into the other. So the benefits go beyond my 5 points that I've got in this presentation, but you can kind of see how when you're only looking at one single property for eligibility in that one ratio, how that can be super beneficial to you. So now let's get into the spreadsheet. And bear with me, I've got horrible eyesight. Okay, so I threw this spreadsheet together for you, and I can send this to anybody who wants it. But I use this to kind of give me a picture of where the eligibility of a single property is at, because it allows me to look at the LTV and then the ratio down here. So let's say, for example, we've got a property that's 320,000, and I'm guessing that this is protected. So let's protect it real quick. Okay, 320,000. And closing costs, who really knows what closing costs are going to be? But let's estimate anywhere, let's say $9,500. I'm not saying they're going to be $9,500 because I have been processing my own DSCR loans, which saves people about $1,000. Also, the company that I work with for the majority of my DSCR loans, the more you have going with that company, the lower your closing costs are. Also, there are closing costs like LLC verification and certification. If you do one, you don't need to do it on the other. So closing costs can be kind of scalable if you want to put it in that term. So for this purpose, let's go $9,500. And I'm going to do two different examples here, but let's start with $400,000 as an appraisal amount. So when we do an appraisal, by the way, we're doing a 1004 and a 1007. So the 1004 is going to determine the value of the property, and the 1007 is going to determine the rents of the property, essentially. So because we're looking at LTV, we need the 1004 version of the appraisal, and because we need to know rents are, we have the 1007. When it comes to the actual amount that we use, we're going to run with the 1007 amount unless you've got an active lease and can show recent payments for the last 2 or 3 months, which pretty much every investor does, right? So if your current lease amount is higher than the 1007 amount, then we're going to run with that. So anyways, let's take a peek at where our LTV is. So in this situation, our LTV is off by the closing cost amount. So let's actually change this to 375 so it doesn't look like it's an error in calculation. Okay, so you can see here that the LTV is going to be 87.87, right? That means you're short of equity to do this loan by 29,000, which may not necessarily be a good situation for you, but what this does for you is it allows you, the spreadsheet allows you to visualize kind of where your properties are at. And I know most investors out there are also real estate agents, so they've got a pretty good finger on where values are. So let's say that this one actually appraised though for 450. That means you're sitting with 37% LTV and about $30,000 in equity. This is, when we talk about the flexibility, the scalability of this loan, this is what can be used to purchase, to add down these columns, right? So maybe one isn't working out here. Maybe you don't know if you've got enough down payment. Move this over here and add it to that column. So you can start seeing where this spreadsheet can be pretty valuable for you. So then let's determine the DSCR ratio, and that again is going to be the real determining factor of the eligibility of the property. This is going to determine whether or not you're bringing in cash or whether you have cash to use. This is going to determine the eligibility. So the principal and the interest, let's say 25 hundo. Hazard insurance, 100, pretty average. I'm guessing property taxes somewhere around town for you investors, probably about $260 a month. So your PITI is going to be $28.60. We don't know what your DSCR ratio is yet because we don't know what your monthly rents are. Let's say, however, your monthly rents are $3,000 a month. So that means your ratio is going to be a 1.05, which means you qualify. This is, when we look at this and when you're using this tool and you're plugging in these numbers, these are based off the interest rate that you're currently working with. So let's say, for example, this number comes in at closer to like 9 or 0.95. With my interest rate Maybe that's going to be lower, so maybe your principal interest is going to be lower. Obviously, hazard insurance and property tax are going to stay the same. But you can kind of see if you're working with a spreadsheet and you're sitting with a DSCR ratio of like 0.95, how close you can be to getting there. And even if it's a matter of buying down the interest rate so that we can get the ratio down, you're almost there. So let's do it. Even if you don't know if you can do it, we can certainly have a conversation and see if that's a possibility. If, for example, your rents were like, say, 3,500. I don't like 3,500. Let's go 3,600. It's going to be a better ratio. A 1.25 ratio versus a 1.0 ratio is, like I mentioned earlier, going to benefit you when it comes to terms of the loan. It might mean a better interest rate, and it might mean lower closing costs for you. So I love the spreadsheet, so feel free to use it how you will. I'm going to include this as a Google Sheets, and hopefully all the macros go over with it. Once you get it and work through it, feel free to give me a call and throw any questions my way. I love the loan. I love working with investors with this because it's in my mind a huge opportunity. Anyways, thank you for sticking with it and listening to my rambling ons. I hope this has been beneficial for you. And if you have any questions, I am Sean Leland with Nexa Mortgage. Got all my info down here, so feel free to reach out. Anyways, take care. Love ya.